Good morning, good afternoon. Thanks everyone for joining. I'm Kevin McPartland, Head of Market Structure and Technology Research at Coalition Greenwich. We're really excited today for a great conversation, the next in our series Behind the Market Structure. Today we have Scott O'Malley, the CEO of ISDA here with us. We have so many good things to talk about. Scott, thanks for joining us this morning.
Well, thanks for having me. I'm looking forward to this.
Yeah, so just a couple of housekeeping items and then we'll jump right in. Questions are welcome. You can type them in the question box. We'll do our best to interject them into the conversation as we go. If we run out of time, we will also do our best to follow up after the fact. After the event, you'll be asked to participate in a very brief survey to let us know how we did, what you liked and didn't, what else you'd like to see going forward. We do look at them, so please do take the 2 minutes to do that. And then finally, we are recording the webinar. So a few days after the event is over, we will send around a link to that recording and a brief write-up as well for attendees, so keep an eye out for that. And so with that, we'll jump right in. So yeah, Scott, so you and I met a good decade ago now, right? Right as you got to the CFTC and the whole Dodd-Frank conversation was really going. And as I've told you, you were really my introduction to Washington. So thanks for that. But maybe you can tell us how you got where you are today and sort of what that winding path was like from college to ISDA today.
Well, if you want to go all the way back to college, briefly, I interned and then I had a job for a year working for the Bond Market Association at the time, which ended up becoming SIFMA, one of our good partners in financial services trade association work. I worked for Micah Green at the time, and that was a fabulous experience. But then I went to Capitol Hill, where I always wanted to be. I did various jobs on Capitol Hill, starting by answering the mail. And that gave you, when you're in election politics, right, worrying about campaigns, worrying about your job every 6 years or your boss's job every 6 years, it's good to know what the people think of you. And so actually answering the mail is a very important role. It's a bit tedious, but it's pretty important. You got to respond to those constituents and making sure you make that connection and they feel the connection. So it was always that it's an important job, but it's relatively low level job as well. But thankfully, I worked my way out of the mailroom into various policy jobs. I kind of focused on energy and environmental issues, business issues in general, financial services. So it was a fairly large mandate in the work that I did, but I spent a lot of time on energy and environment. And I guess I wish you a happy Earth Day today. But this is where I kind of focused, and I ended up going to work on the Energy Committee. I ended up working for Pete Domenici in the Energy Committee, and out of there, I was picked by the Bush White House and then the Obama White House to be a CFTC commissioner because of my energy background, oil and gas and various energy, working on the energy bill, things like that. Loan guarantee program to stimulate and encourage investment in new innovative technologies was an issue that I worked on. And I like to joke, at the time I was as clerk of the Energy and Water Appropriations Committee. My job was to kind of allocate the $32 billion that goes to the Department of Energy from the Senate side. We reconcile that with the House, and that becomes their budget. But in the Department of Energy, you have the National Nuclear Security Administration, which handles weapons of mass destruction. So as you all know, Warren Buffett also observed that derivatives are weapons of mass destruction. So I kind of have cornered the market on that a little bit. I don't think Warren Buffett is actually correct, and certainly after the work that we did at the CFTC, I think the market is far safer and better prepared to handle any significant attack. But I do have kind of a unique experience, and I never really applied one job to the other, from national security to financial security.
Clearly you have a skill set that can be matched by no one else in that regard. That's awesome. Sure. So at the CFTC, right, in the end, right, which maybe started out looking like a very commodities focused job, it turned into something, and so it sounds like was very different. So you created the rules for the derivatives market effectively. Now you're implementing the rules. So what has that transition been like? And do you feel like all the work you did it work?
It's fascinating, and when we were joking earlier, but when I was told I was going to get this, I was nominated for the position, a friend of mine came up and said, Scott, it's kind of a sleepy little agency. There's not much going on. This is 2008. And he said, you should really think about getting a hobby, right? Just to fill your time, because you may not even go into the office every day. I'm like, oh, I've never had a job like that. I don't know what I would do with that. But lo and behold, Gary Gensler also became chairman of the CFTC. We had a financial event, and then we had the regulatory environment. So what turned out to be a little sleepy agency, I think people really understood the power of the CFTC and the role of the CFTC, and I think put it on everybody's radar screen, because that little agency really did a lot of work. And between 2009 and actually 2010 to 2014, we voted on like 65 final rules. We transformed the entire market structure for non-cleared products. It started with swap dealer rules. We had trading, and we've got 23 jurisdictions today that I think have trading worldwide. 17 out of 24 FSB jurisdictions today have mandatory clearing. And today we have 90% of the interest rate derivative market notional is being traded or being cleared at a clearinghouse, and it was 0 back in 2010. We have new margin for non-cleared products, and based on the research we've done and what we publish, we have over $207 billion in initial margin that is backing up the non-cleared markets. Trade execution in 23 jurisdictions, as I noted before, which gives you, it's not a risk issue, but it is transparency. We have over $2 trillion in euro funding in common tier 1 equity due to new capital rules. So the system is really transformed here. We did an enormous amount of work. We've got reg reporting all over the place. I think there's still, and you heard this as you followed the debate, I had some issues with the reg reporting, the way it was done, because it was kind of send us everything, we'll sort it out later. That still doesn't give us the same, I think we could have done it better. I think we should have started with risk. I think we should have started with something small and worked into something big, and it should have been better aligned with our international colleagues. That being said, we have far more and greater transparency into the market. It's valuable data that I would even think that you guys use it here at Greenwich to understand what the market looks like, and I think that's extraordinarily valuable. So, we'll get into this, I'm sure, but my job has changed significantly now that I'm on this side. But it was a fascinating and clearly a full-time job, and I also love doing the work on the technology advisory committee, having kind of brought that back and focused on things like high frequency trading and automated trading and data standards and the importance that can bring. All of that was interesting, fascinating work that I'm grateful for the experience and grateful to be nominated, and had a terrific time doing it.
That's awesome. So that's a great segue, the technology. So why don't we talk a little bit about technology? So there's, obviously been I would say since the credit crisis, I guess that was probably the original catalyst, a huge digital transformation, really in the whole world, but in financial markets in particular. The last 3 or 4 years, even more so, feels like data and AI have really started to make an impact. So, technology and derivatives markets, is much more than e-trading, right? So, can you talk about sort of what you're seeing change, what you feel like has been impactful, and what are some of the interesting things we should keep an eye on?
Yeah, well, there's a lot of fascinating technology. And on one hand, you think about the high frequency trading and you think, wow, that is absolutely tip of the spear in terms of technology and innovation. And you hear some of these trading platforms are using AI to sort out different strategies and broaden their horizon to new markets. And it's fascinating. And the technical complexity with it is just kind of otherworldly. But then you kind of step back and look at the derivatives business, and you're like, well, this feels like a museum tour, because some of this technology is pretty old. And I would take collateral exchange as a great example. You're still using fax machines. We shouldn't have such a huge contrast between the high frequency trading and the fax machine, but we do, and it's part of our reality. And we have to think about what is the transition? And I'm really happy that I'm in this role today, because now we've handed off the regulations and we're thinking about the strategies that can transform the industry for the best, right? Bring efficiency, bring greater automation and digitization. So when we started on this process, we realized that there are a lot of common infrastructures, thanks to the regulations, right? You have trade execution, you have clearing, you have a mandatory and global perspective on posting a margin, and we're kind of halfway through that process. A really big phase this year for IM in phase 5, where thousands of buy-side counterparties are going to come into scope, and they need automated solutions to really deliver that collateral in an efficient way. You have CCPs driving innovation, and really these common infrastructures give us a common structure to really develop greater automation. And so we use that common infrastructure and say, all right, what do we need now? And at ISDA, when we think about our role, it's really to convene the market and bring everybody together to develop certain standards and behaviors, and develop solutions if we can. And we've been pretty successful in that track record, particularly around contracts, which everybody knows the ISDA contract for. That's legacy, and we're still updating it. I mean, that's religion to us. We have to update the documentation. But when we update the documentation, we're now thinking about a digital framework, right? Put it in a digital framework as an original document. That way, you're not re-entering it at every step of the life cycle. And so, putting it in once and then sending it through the life cycle will help, really make things more efficient, make things more accurate. So we think about delivering it, and to do that, you have to have a data standard. So one of the things we're working on is a common domain model. That's the foundation, right? If you think about this pyramid of the things, the data standard's the first thing that you start with. When you think about CME or ICE or LCH, right? Any trading market has a common taxonomy for how you describe the events, how you interface, how you get data and information. All of that's standardized. Even the tickers are standardized. So we want to extend that type of standardization to the derivatives business, not to make it on exchange necessarily, but to give you that capability to automate and digitize. And then you can develop, bespoke products. But, data as bespoke isn't very useful if you can't share it. So it really is an opportunity to transform using these common infrastructures and to build off of that. So we're going to build a taxonomy, and we have developed that. We're going to build smart contracts, so the contracts themselves. We're going to have digital definitions, and we're going to roll out the new interest rate definition that's new largely because of the IBOR changes. But we're going to have a new definition, and it's going to be in a digital format. No more paper booklets, no more printouts and lookups. It's going to be in a digital format that systems can ingest, and then we just take it from there. And we think about everything ought to be automated and digitized. When you think about the pandemic, as we're both working from home, the old paper files, I don't have paper files in my home. That this is a dining room, for God's sakes, right? I can't put a filing cabinet in here. So those kind of things, we can't go back to that old way of doing things, of paper and things that don't scale. So it's got to be scalable, and it's got to be automated.
Yeah, I mean, one of the things that's fascinated me over the last few years is I felt like even back, like we said, 10 years ago, so much of the focus for technology was about trading. And trading, you would always think, okay, like equity markets, order books, high speed. I think the markets have learned and the technology has evolved that there's a lot of efficiency, right, that we can put into markets that are completely illiquid, that are completely bespoke, but you can still make it, automated and efficient and done over a screen, right?
Yeah, you can keep the bespoke nature of this, and we're gonna be thinking about ESG markets and developing carbon markets and verification of meta registries. Well, all of that is really bespoke right now, and it's going to go through its life cycle. And it starts bespoke, where you aggregate liquidity and solve specific problems and manage risk, and then it evolves, and then you'll have options of exchange traded markets, cleared markets, and then OTC markets as well. And that's an appropriate ecosystem for good risk management and to developing, financial solutions. And it's just a natural process of things.
That's great.
And
So
I think we're always fascinated by the technology because the gee whiz stuff was the exchange traded stuff, right? And now we're trying to figure out, all right, how do we take really innovative ideas and then bring that throughout the entire life cycle without changing without breaking it and still keeping its purpose. But there's a lot more digitization and automation that can be deployed because it's efficient.
It's totally. Well, you said smart contracts, right? Like all of the distributed ledger. I mean, that's fascinating, and that's certainly not sort of high-speed trading in markets, but that's become one of the most fascinating topics, in fintech today. So it's another good segue. So you mentioned ESG. We were saying even in the last few weeks, it's just more and more and more topical. Announcement in Europe today about standards there, which I think the whole market is ready for. So what is ISDA looking at in this regard? What impact does all this ESG talk have on the derivatives markets?
Well, kind of at first blush, you say, what's a green hedge or what's a green derivative? And because it really is the cash market, right? Cash bonds, cash loans. These are the green products where you're going to have the investment, and that's fine. And derivatives back it up, right? That's the hedge and risk tools. If you're going to set up an index, right? Somebody's going to make an index. You want to have a hedge behind that, and there's so many different things. If I call on my old experience in the energy business, what is it going to take to transform our economies? And the data seems to be like $100 trillion a year. What's it going to take to transform all of that? It's going to take enormous financial resources, and you need to have the risk management tools behind that, whether it's duration risk or any other type of risk that people are dealing with. There's some good hedge products that you can use that will manage that risk, which is super important to long-term financing, and that's what it's going to take. Huge amounts of cash being mobilized towards green and innovative technology. So we look forward to, obviously, in the financial sector, supporting that in a very aggressive way. And I'd have to say, based on my experience in Washington, the industry has transformed quite a bit. I mean, we've adopted green principles. We've adopted a principle for pricing carbon, Paris Accords, and all of the countries now are really reaching targets. I think there's 1,400 firms that have said, we're going to have a net zero carbon strategy. Well, how do we manage that? How do we support that? And I think, it's voluntary carbon trading to get to that net zero, investing in those new technologies that can mitigate and reduce or eliminate carbon, and then making sure that you can purchase those and share those to get to that net neutral position. And it's just it's a process that we need to get to where we want to go, and it's going to evolve over time. And I think ISDA can provide documentation, right? Definitions, help with the automation, help with the technology and the carbon registry. We're going to need to integrate some confirmations in that space just to make sure all the standards and definitions and data are held in a consistent format to really deploy it effectively at scale, right? This is a global problem, and based on the summit today with President Biden, like leaders around the world, this is not something that's going to happen in this market and that market. This is a scale play, and it has to happen soon. Now it's probably a little late, actually. So let's get on with it. We can't tinker. We have to go all in, and we're ready. We're ready to assist, but it's not going to be delivered by ISDA alone. We have to work with others in the cash markets and loan markets and syndication. We have to link up those markets to make sure that everybody's using the same standards, taxonomies, data, and information. And that's what you hear a lot of cry for, right? Give us standards, give us certainty. Mm-hmm. We want to do it. How do we do it? It's going to take everybody's real effort to support this, but it's an exciting thing to do, and I think we're up for it.
Yeah, no, it's changed a lot. I mean, just a few years ago, ESG investing meant buying Tesla stock, right? And obviously the world, the investors, the dealers, like you said, data providers, it's all gotten so much more sophisticated, and we've moved so far.
We published a paper recently, and as you can get it on our website, but it listed all the various kind of products around this. And there's some exciting things that are being done with, like, an interest rate. products. You establish KPIs and you set some goals, and if you achieve those goals over time, you get cheaper financing. And I really commend banks, buy side, corporate users for kind of coming up with those innovative technologies, and those are completely bespoke, and that's fine too. And we just need to give them the infrastructure, the tools, the data, the contracts to make sure that they can get those done cheaply and efficiently.
Sure. So the other fun topic of 2021, Libor, right? Obviously the death has been communicated. I think some of the goalposts have moved slightly, right? But where are we as an industry? How are you feeling? Do you feel like the industry is prepared or is preparing properly, and what else needs to be done?
I kind of feel like the guy in the cartoon with the sandwich board, and it says the end is near. The end. That's me with regard to Libor. And again, I've kind of been able to watch this from the CFTC when we brought the prosecutions. We've unpacked the questions around what do we need to do, and then we walk through the principles around how we take the existing IBORs, right, upgrade them to make them more more resilient. And then now we're in the stage of ending Libor, and as you said, the end is near, or the death has been communicated. In most Libor settings, 24 of them, in fact, are going to cease publication on December 31st, 2021. Another 6 are going to kind of be phased out through by the FCA, calling them non-representative, and they will end. And then we have 5 US dollar Libor settings, which will end in June 30th of 2023. So that is the end of the end, right? The end is near. And Libor is on an irreversible course to demise. It is not coming back. It is not going to be extended. Truly, the end is near. And I think one of the reasons I say that is because the US regulators are going to say, yeah, after 2021, or have said after 2021, no new Libor is going to be written. Certainly in the United States, that's going to be probably the position of the FCA. So when you don't add to that pool, you can really work that off. Now, for ISDA's kind of role, we've been very supportive of and working since actually back in 2016 in terms of developing a fallback. So there's an enormous book of business, long-term contracts that have been written against Libor that will exist long beyond 2023 or 2021. And we need to create a safety net or a fail-safe to make sure that those contracts, when Libor disappears, they have a reference price in there that it doesn't go to doesn't create contract frustration. So what we did was develop fallbacks, and it's a methodology to transition from the IBOR, the relevant IBOR it's written against, to the risk-free rate, and maintain kind of all the economics around that. So it's a fallback that we implemented. It became effective in January of this year, and has really seen an enormous amount of uptake. We have nearly 14,000 participants that have signed on to the protocol to adjust their contracts. That gives us the confidence that ending Libor will not result in some massive dislocation of all of these long-term contracts, that they actually have a reference price based on the risk-free rates, which are better, safer rates that are transparent and based off of transactions, and that makes the system safer. So then we can really end the Libor settings and not create new ones. Now, that's for the derivatives industry. There are plenty of other challenges with tough legacy loans, et cetera, that have to be dealt with because they don't have the protocol mechanism that is to apply to support that transition. So you've got a lot of, they call it appropriately called tough legacy, right? And you got to work that through and work that off. But things like a legislative solution, which is being sought. We have a New York solution that provides a lot of certainty there, but they're looking for federal legislation as well. The UK, the EU have all developed solution sets. There's also other countries have taken a multi-rate strategy, so it's not kind of cliff edge issues. But yeah, this Libor has been 1, 2, and 3 in order of priority every day I wake up, it seems. And it's been a lot of work, but it's been quite satisfying as we've been able to have success in transitioning, and we have good support from regulators, and we have good market adoption. So the one thing that we really need to work on is liquidity in SOFR, and that's the risk-free rate in the United States. SONIA is doing quite well. I think that's trading at about 45% of all new DV01 is being written to SONIA, and that's up considerably from a year ago. I think that was at 28%. SOFR in the United States is roughly about 5%. A lot of upside, but with the direction from the regulators saying no issuance of new SOFR, that number is going to grow, and I think we can watch it grow as people really understand that truly the end is near for Libor, and they're going to start writing against new products.
Well, I wonder if it's that, there's certainly a couple of alternative reference rates that have been proposed in the U.S., right? There's Maribor, Bloomberg has an offering. I don't know. In the end, that should be good. You think that competition is good and let the market choose, but then maybe that's slowing SOFR adoption a bit as well.
Well, if you think SOFR at 5% is low, these rates have very little liquidity. The risk-free rate is where the market's going to coalesce. No complaints about having other rates out there, but I think people really need to put if you want to get this transformation, you want to be ready. That the liquidity is going to amass in SOFR, my guess. As it has in SONIA, right? It's not because people, you think about Libor. Why Libor? Well, because everybody was using it, right? So you really want to create that pool of liquidity. Let's get on with it. We'll see how this plays out, but I do think SOFR is going to continue to grow. I think it will be the risk-free rate, and it's just changing behavior is the big thing.
Yeah. I mean, even CME's SOFR future chart, the line is only going in one direction, right, with regard to open interest and volume. So it's certainly moving. So we don't have a ton of time left, but we can't not talk about uncleared margin a bit. I think that's probably, if Libor 1, 2, 3 uncleared margin's got to at least be 4, 5, or 6, right? So sort of where are we with that problem? I mean, this has obviously been a multi-year initiative across the industry. You quoted some stats in the beginning. Where are we? What's next? Other digital solutions probably to help here too, I'd imagine as well.
Yeah, this is a big year because the buy side really comes into scope. It's that $50 billion threshold. So we have 314 entities coming in, which with 3,600 counterparties. Next year, over 700 entities with 5,000 counterparties. This is a massive repapering, right? You have to repaper using CSAs and the new documentation based on the regulations. We've published that, and we published that on a digital platform, ISDA Create, where people can convene to create those digital contracts that will allow you to kind of populate downstream. We've also created ISDA SIM, which is the standard initial margin methodology, a completely transparent, regulatory approved model that everybody can use. But those are great tools, mutualized services that are efficient and effective that everybody can use and work through. But it really comes down to counterparties sitting down, putting in place the documentation, beginning to put in the operations, right, to have the custodians ready and to figure out how you're going to operationalize all of this work, and then the execution and getting the collateral exchanged. There's a lot of work to be done. The deadline is September of this year, 2021, and then 2022 for phase 6. We can't, say it often enough. Get ready. Work with your counterparties, work with your custodians to make sure you're ready to exchange collateral in September. It's a big lift. We haven't done the first 4 phases over the past 5 years. Haven't even done as many as we're going to do in 2021. And so that's the big challenge, because we phased it as regulators by big banks first, and we've worked through that. Now it's the buy side, and it's just a big operational challenge.
Do you feel like you've seen notable moves into cleared products or exchange traded products over the last year?
Absolutely. I mean, there's a huge move into 90% of interest rates are cleared today. Capital efficient, right? It's cheaper. using that. But there's still a huge need for non-cleared products as well, and that are either not offered for clearing or they've chosen not to put them into clearing. And so we've always wanted to make sure, as both as regulators and as the industry, to make sure that there's a robust way of managing that and a cost-effective way, because not everything is going to be can be cleared or exchange traded. So for the rump of that work we have to have another solution for that.
Right. So we're just about out of time. I suspect that a lot of folks on this call are anxious to have an ISDA conference back in person, share drinks with you again. How are you guys feeling about trying to get those events back up and running in person when it feels safe?
Yeah, we'd love to do that. This is a great way to reach out, and we've doubled the number of people we've reached by using webinars and Zooms and everything else, and that's been fantastic. We've educated and reached more people, and which is particularly important when you have IM and Libor coming up. But there's nothing to replace, the in-person event, the networking, the conversations that happen. It just happens so much faster, and it's, I hate to say it's spontaneous. It's that water cooler, but it is, right? And so we have in the second week of May, we have our online ISDA AGM, in which we invite everybody to come and join us, and we're going to have great speakers. All the regulators are going to be there, and interesting topics, et cetera. But I hope Madrid in 2022 is what we're planning on, and we hope to see everybody there as well. But we just have to be patient.
Yeah, that sounds incredible. Well, we will all certainly look forward to 2022 for sure. Great. Well, with that, I think we've hit on all of the buzziest topics and derivatives in the last half an hour. So thanks for taking us through the updates, and lots more to continue to talk about. So thanks, Scott, so much for taking the time.
Well, a big fan of the work you do, Kevin. We've worked together on many projects. I love reading your research. Thank you very much for having me on your webinar.
Thanks so much. Really appreciate that, Scott. And thanks everybody for listening. Keep an eye out for the write-up and the recording, and we will see you again. Thanks so much.